Right, so welcome to the explainer video for your Fast Track Mortgage Plan. Everyone that does this course gets their own copy of a Fast Track Mortgage Plan, and it's important that you understand this document when you get it, because if you understand it and you put this document into practice, it will change the financial trajectory of your family. That's a hard word to say. So it's really important that you get your head around it. It's important that you understand this because I've now been training people on this for a long time, and the people that understand this and take it on board and put this stuff into effect, their financial position grows very, very quickly, and yours can as well, provided that you get a full understanding of everything and you know how to work it. So this is a copy of this is a sample plan that I've created, and I'm going to talk you through it so that you can understand yours when it arrives. So first of all, we've put this disclaimer on the front page which says the following report is a snapshot of what you could achieve based on the information that you have provided. This report doesn't take into account future pay rises that may occur or your future increases in expenses, though we have increased both at the rate of 1% per year. Your mortgage is your mortgage and it is still your responsibility at all times. It is up to you to follow the Fast Track Mortgage system, and how closely you follow it is up to you. This document is to be used as a general guide and as an education tool to teach you how to pay your mortgage using optimum debt reduction techniques. All right? Okay, that's because we are advocates of personal responsibility and everyone still needs to own their own journey. Okay, so this first page here, it just shows you some of the base interest rates that we use, LEM rates if you have a low equity margin on your mortgage. The security value, you'll see that this is the value of your house. In this example, is $800,000. If you enter a different figure, then you'll see a different figure there. And then we have the tax brackets that we apply. Okay. Actually, did I miss student loan pay rates, ACC rates as well, right? So that's just some of the nuts and bolts of the report. And then here we've done a report for Homer and Marge, and we're going to look at their situation. So you can see that Homer is just over 40 years old, nearly 41, and Marge is 39 and 9 months. We've got their address and their contact details and their phone number there. And this is now the income table. So Homer earns 95 and Marge earns 90. And then here in the yellow portions, you'll see that it's broken down. Tax is taken off, ACC is taken off, KiwiSaver contribution is taken off. When you fill out your data collection form, you'll be entering in your own KiwiSaver contribution rate. If it's 4%, then put 4%. If it's 5% or 6%, 8%, 10%, then you add that in. But here I'm working with minimums of 3% KiwiSaver contribution, which will probably be the most common. And so that's the negative 2850 for Homer. That's his KiwiSaver coming off. So then we're getting to the figure that we really want, which is the net income figure, which for Homer is 68560. And for Marge is 65,429. So really that's the exercise of the first page. Is I want to know what is the net income after taxes and ACC and KiwiSaver, how much are we getting in the hand? All right. Next, we've got the expenses. So you'll see that in this example here, it's broken down into lots of different expenses. When you get your version, it might be entered just as one expense because we would have downloaded all those expenses from your annual spending plan to save you double entry, to save you having to do it all again. Your individual expenses will be in your annual spending plan, but we will bring them across for you into this page here as one entry, which covers all of your annual expenses. Okay, so this Homer and Marge, you'll see here, have got a total of just over $70,000 per year as their annual expenses. So now we move on to the debts page. This is the debts page. So they've got a $600,000 mortgage, 3% is the interest rate, and they've got current term of 28 years to go. So we've just entered their mortgage here as one loan, one $600,000 loan. But say, for example, you've got two loans or three loans, then you'll enter in each of those loans with each of their interest rates and each of them with their remaining terms, which is likely to be the same remaining terms, but not necessarily. Okay, and so this is where you enter your debts on your data collection page, or you enter them out separately like that. And then you've got a car loan here for Homer and Marge. So they've got a car loan that they're paying off, and then they've both got student loans, you can see down the bottom, which will take some of their income away as they pay off their student loans. So this page here is really important to understand. So this is like a 5-year financial view or review of the situation. So you'll see here across the top, we've got year 1, 2, 3, 4, 5 across the top. And then we've got some vertical values. So if we just look inside the black box, which is year 1, this will be the easiest way for you to understand this page. So these are the two net incomes that we had for Homer and Marge, 68 and 65, and it equals a total of 133,989. So that's their total net income, okay, in the hand. And then we're going to subtract from that their total living costs, which is 70,200. You remember that figure from the expenses page. And then as we scroll down a little bit, we're now going to subtract from that their debt repayments. So they had debt repayments here for their car loan. You'll see that their car loan repayments last for year 1 and year 2 and then drop off after that. Same for their student loans down here. The student loan was going to get paid off within year 1, so that's why it drops off after that. And then we've got their mortgage repayments at the interest rates entered and the terms entered, and this is their mortgage repayments going forward. Okay, so once you basically look at their net income, less their living costs, less their debt costs, we get this very important figure here, which is the annual surplus. And this annual surplus should look very similar to your seed capital figure. Okay, there might be sometimes just slight differences because of the different ways that income is sometimes entered, but this is your annual surplus here is basically the same as your seed capital, and that is what you're going to use to build your family's wealth position. Okay, so down here, if I just scroll a little bit more, because this couple here, Homer and Marge, have an annual surplus of was it 22,747. You'll see that in the box here. This tool is saying that their optimum revolving credit or offset facility should be 23,000. It's slightly bigger than what their annual surplus is. Now, this doesn't take into account that Homer and Marge might have some other savings right now, and it doesn't take into account that we might want to put aside a little bit more for things like car replacement or emergency fund. But anyway, for this, we're just using today we're just using their annual surplus, which is 22,747, which is why this Fast Track Mortgage Plan tool has said that their lump sum payment account, which is essentially their offset account or their offset loan or their revolving credit, should be at 23,000. So often when I'm doing this in one-on-ones, I might round that up to 25,000, but if it was 23, that's fine. That's no dramas with that. So here we've got if we go on to the next page, we've got their Fast Track mortgage structure. So we'll remember we've got 600,000 total lending. We've got 23,000 that's being allocated to their revolving credit or offset loan, and that leaves 577,000 after that. So if we scroll down, we now have a suggestion of what their mortgage could look like. So we've got 23,000 as their fast track portion, which is their revolving credit or their offset loan. And then in this example, I've broken up their remaining lending into 3 pretty much equal loans. We've got 192 on 1 year fixed, 192 on 2 year fixed, and 193 on 3 year fixed. And you can see there's a little picture here on the right hand side, which just shows you that breakdown and what it looks like visually. Okay, and then if we go to the next page, we've got their fast track results, and we've got here the graph that shows you what result they could have. So basically you can see that they had 28 years to go, and they've got the ability now to get freehold in 10 years and 10 months. And if we look at the round graph at the bottom there, we've got interest savings of 181,000, because blue equals interest saved and yellow equals the interest that they are still going to pay. So if they did nothing at all and carried on their 28 year plan to pay off this mortgage, they would pay 288,000 in interest. But now we can get them saving 181 and only paying 108. So that's a pretty massive saving, $181,000, and they get to pay off their mortgage in 10 or 11 years, which means that so many opportunities arise out of having no debt repayments 17 years ahead of schedule, right? So this is a really powerful, and sometimes I suggest to people that they print this page out and put it on their fridge or put it on their bedroom wall somewhere just to keep them motivated, so that you can remind yourselves why you're doing this. You're doing this because you're going to pay off your mortgage fast, and that's going to create equity fast, and that's going to allow you to invest, and that's going to change the future of your the financial future of your family, right? So keep this page here as in a place to help keep you motivated. So remember, after watching module 5, you will have worked out that that in order to get this result here, we are going back to this page here, and we are looking at the annual surplus, and this is your seed capital, and we are going to use this seed capital to pay down your mortgage. Now, while you've got a mortgage, this is the best way you can build wealth. The best way you can build wealth is to get rid of your debt. Mortgage is debt, and if you use your seed capital to build wealth through paying down your mortgage, then that is the best thing that you can do right now. At a later date, if you want to, you can use that seed capital to invest in other things. Like, for example, you might say, look, I really want to invest in gold. Well, I'd say pay down your debt first, and then your seed capital can go towards investing in gold after your mortgage is gone. All right, but first of all, we want to focus on the foundations, which is clearing debt. And you can see that Marge and Homer here have got the ability to clear off their mortgage in 10 or 11 years. That's fast, okay? And this is having an annual surplus of around about 20,000, 22,000, which is achievable for a lot of New Zealand families. So a lot of New Zealand families can get their mortgage paid off in 10 years or less, and that means they are now set up and they've got a strong foundation to continue to grow from that place. Right, so we'll keep scrolling, and we'll go on to the next page, which is a KiwiSaver projection. Okay, now there's lots of different ways to do KiwiSaver projections, and so this is just one method, and we've used a set of criteria that we think is a reasonably good set, but different KiwiSaver calculators use different versions. So I'd actually take all calculators with a grain of salt. But this is just to give you an idea. So we've got here that Homer has got 25,000 in his KiwiSaver currently. He's contributing 3%. His employer is also contributing 3%. He earns $95,000 a year. He's got his provider is ANZ. He's in a balanced type fund, which is going to give him a 3% fund return. And his retirement age is 65. So he should have approximately 264,000 in his KiwiSaver account at retirement age. And then the same for Marge. She's also contributing 3%, employer 3%. She's earning 90. She's using BNZ, and she's got a 3% fund return as well. So she should have about 293 when she gets to completion age, 65 years old, and should have a bunch of cash. She's going to work a little bit longer than Homer because she's a little bit younger at the moment. And then we've got that based on an annual living expense of 75,000. This means that the KiwiSaver funds will run out after about 9 years. And so at that stage, Homer will be 74 years old and Marge will be 73 years old. And this page is not intended to scare you, but it's to point out to most people that KiwiSaver alone is unlikely to be enough to see you through your retirement. Now, for some people, it might be. For some people that have started very young and have been contributing their whole lives, they will have quite decent KiwiSaver funds, and it will make a huge difference. But for most people, on its own, KiwiSaver is not going to be enough. Now, keep in mind that we're not taking into account that you might be getting also paid a government pension from the age of 65. We're not taking that for granted that that's going to continue forever, which is why we haven't included that in this calculation. If you are lucky enough to get a government pension, then that will give you probably the money to pay for the basics of living, so that you don't need to use KiwiSaver funds to contribute towards that. But in this worst case scenario here, we've got KiwiSaver funds being depleted after 9 years, and clearly that's not going to be enough to get most people through retirement. Right, this is a property portfolio page just to show Homer and Marge what they've got the ability to achieve. So we'll see here that they've got $800,000. $800,000 is their value of their house, and they remember they had a $600,000 mortgage, so they've got equity of $200,000. And we're going to look at the ability of them to purchase an investment property for $550,000. Okay, so what this is saying, if I scroll down a little bit, it's saying that the Fast Track Mortgage Plan is designed to create equity as fast as possible if you intend to become a property investor, based on a 6% capital growth rate and current loan term of 28 years under Reserve Bank LVR rules for new builds, which is 80% LVR because we encourage new builds. You'll be able to purchase your first investment property in 1 year and 6 months. However, if you use Fast Track Mortgage Plan, that will get down to 1 year. So in this example, we're actually only saving Homer and Marge 6 months because I've got quite a lot of equity already. And so they're pretty close to being ready to buy their first investment property. But if we scroll down a little bit more, we'll see that if they continue using Fast Track Mortgage Plan, you can have 5 investment properties within 8 years and 6 months. And this would save 10 years over conventional method. And you can see there's amounts of money saved on each house over here down the right hand side. So being able to buy houses earlier saves you a truckload of money. And effectively, that makes you a truckload of money. So the earlier that you can buy your investment properties, the more you'll earn from them. So this is where using Fast Track Mortgage Plan to create equity faster allows you to invest earlier, and that allows you to make more. Okay, so in this projection that we've got here is actually a really conservative because we're only using the equity in Homer and Marge's owner-occupied house. We're only using the equity in the owner-occupied house to invest in further properties, but in reality, they would also have the equity from each investment property that they buy, so they've actually got more equity and they could actually go far faster than what they see here, but certainly they'll do pretty well even if it was just based on their owner-occupied property. Okay, property portfolio page. This is just to give you an idea and to motivate you to consider property investment because the numbers are actually amazing, pretty fantastic. So if you remember that we're going to use the equity in the owner-occupied house to leverage to buy your first investment property. So in this example here, we've got Homer and Marge buying their first investment property for $550,000, and their mortgage is going to be $550,000. All right, so they're borrowing 100% of the purchase price, and basically what the bank does is it's got the owner-occupied house and it's got the rental property house, and they basically are putting them all together. So overall, the equity and LVR position is good for the bank, and that's why the bank will lend $550,000 to buy a house for $550,000. So they're borrowing the whole lot. We've got an interest rate of 3%. We've got a 30-year term, and this shows you what the mortgage repayments would be if they were P&I, principal and interest, and versus interest only. Okay, so in this example that we're looking at today, we are assuming interest only, which you can have for 5 years if you are a investor, and after 5 years you can either choose to go onto P&I, or basically you change banks and a new bank will give you another 5 years. So here in the financials, we've got $500 a week in rent, we've got rates, we've got insurance, we've got a 94% occupancy rate, we've got $1,000 a year for maintenance, which I've purposely kept reasonably low because I encourage people to buy new builds, and new builds should have no maintenance costs for quite a while, but maybe after a certain age there will be some maintenance costs. And then we've got 8% property management fee. So I always put in an 8% property management fee because unless you are a property manager, you probably shouldn't be doing it. So I suggest that people specialize on what they're good at, and property management is probably not something that you're good at. So let the professionals do it and pay them the fee so that you don't have to deal with the hassle of tenants and get phone calls in the weekend saying, can you help me with this, or can you fix this, or whatever. Okay. So in this example, we're dealing with 1% inflation. We've got a 6% capital growth rate. And this is actually pretty standard for New Zealand. It's more sometimes and less at other times, but 6% is actually historically pretty accurate. At the time of recording this, which is early 2021, the rate has been a lot higher than this over the last year. And then in this example, we're going to assume that we're going to own this house for 20 years and then we're going to sell it in 20 years. And at that time, we're going to pay the agent 2% commission. This is the real estate agent. We're going to pay entry costs of $2,000 for like legal fees and exit costs of $2,000 for legal fees, both of which should be cheaper than that, but that's just to go a bit on the high side. So then we've got future property value will be 1.9, and then there'll be a gain of 1.395 after all costs. Okay, so we've got here rental income of 24,000. We've got property costs. We've got net income of 17, and we've got cash flow would be negative if you are doing principal and interest repayments. Now, if you can comfortably afford to do principal and interest repayments, which means that you're going to usually put in some of your own income to cover that shortfall, then I'm not opposed to that at all. But most people would go interest only, which means that we're $785 a year positive cash flow, and so the house is paying for itself. The house is paying for the mortgage, it's paying for the rates, it's paying for the insurance, it's paying for the property manager. And just while we're here, the point of really doing the point of getting an investment property is not to put money in your pocket now. All right, so we're not interested in putting money in your pocket now. What we're doing is we're thinking ahead for when you're at retirement age or past retirement age, and we want to put money in your pocket then. All right, so that's the problem that we're trying to solve here. It's about taking action now so that you can have a much better life later on. Okay, so that's why that cash flow at 785 is small. That's, you're making less than $1,000 a year on this property, but it is paying for itself. It's costing you nothing, and it's going up in value all the time. Okay, so what we've got here in the financials explained, basically I'll go down to the bottom because this is the important bit. Is basically saying that when you sell this house and you pay off the agent's fees and you pay off the mortgage and all of that, then you're going to have about $1.4 million in future dollars in your pocket. This is the equivalent of about $1.1 million in today's money. Okay, so if you imagine that you'd bought a house 20 years ago and you're selling it right now, you'd be putting about $1.1 million in your pocket right now, and that would be pretty awesome. Okay, so imagine you're 75 years old and you're no longer earning money, and you had $1.1 million fall into your bank account at that time, then I think that would probably change your retirement quite significantly. So this is the problem that we're trying to solve. We all feel secure when we've got our day jobs and we've got good, strong incomes, but we need to plan for when we don't have those incomes, and that time is definitely coming when you'll get to retirement age and you will no longer have your day jobs. And so this is where you can use Fast Track Mortgage Plan to create equity fast, and then you can use that equity to invest in some 1, 2, or 3 investment properties, as much as you want really, and then one day you'll either live off the income of those properties, or you can sell them and put the profits in your bank account. So pretty powerful figures, and this is pretty much, this scenario here is, sometimes I say to people, this is as close as you're going to get to getting a free house, because the bank is going to give you the whole purchase price for the house, and then your tenant is going to pay all of the expenses for the house. You just need to stay alive and keep your day job. All right, but basically this is as close as you'll get to getting a free house. And this is the summary page. So Homer, you are currently in debt until age 68, but you could be debt free by the time you're 51. By the age of 65, you could have a total of 264 in KiwiSaver, and then the equivalent for Marge, and then KiwiSaver balance will last for 9 years after retirement. So using Fast Track Mortgage Plan, you could be freehold in 10 years and 10 months. That's a saving of 17 years. 17 years is a lot of time. So that's something to get excited about. And you could be paying $288 in interest, but with Fast Track Mortgage Plan, you'll save $180 and pay just $107. So that's a massive interest savings there. Based on your current situation, you could purchase an investment property in 1 year, 6 months, but using a Fast Track Mortgage Plan, you could do it in 1 year. So that's the example just for the first house, but you remember that the real benefit is doing house 2, 3, 4, 5, etc. Right? So this is a copy of Fast Track Mortgage Plan. this is what you're going to get a copy of. I would challenge you and invite you to take it really seriously. Make sure you understand it, because you put this stuff into practice and you will change your financial life. So I hope that you found that interesting. Looking forward to going through your own individual Fast Track Mortgage plan when we do a one-on-one session with you. Make sure to bring any questions that you've got to that session, and we can go through those then. But for now, have a think about that and get your head around the principles. And I look forward to seeing you at our one-on-one session when we go through your plan at a later date. Thank you.